Hi, I'm Andy in Business Development at Mortgage Heroes, and this is Monday Mortgage Minute. Okay, well, here we are. We find ourselves here on Monday, March 2nd. It's a new month, it's a new week, and boy, there is a lot going on, most of which you're already aware of, but we're going to talk about what this relates to in the mortgage and real estate industry. So, first and foremost, the coronavirus continues to dominate the headlines with more cases being uncovered, and also now we unfortunately have more people dying, and it's happening in newer places. So this is a big concern to the global leaders as well as the global banking industry. So even here, you might have seen this last weekend that our president has made some comments about wanting our Fed to take action and lower rates. Now, there's a really high chance that they're going to do that in the coming weeks ahead, but this doesn't necessarily change there being a vaccination for the virus. So even though there's this perception that is being put together that they're connected and that the Fed should take action, that's all well and fine. That's going to help stimulate some lending, but it unfortunately won't immediately help us solve the problem of the virus. So keep your eyes open for the Fed to take some sort of action. There are estimates saying that their Fed's going to reduce by 50 basis points to 75 basis points. In percent terms, that means 0.5% to 0.75% of a reduction of the Fed funds rate. Now, those of you who've been watching us, remember that the Fed funds rate is the rate that sets interest rates for short-term lending, such things like credit cards, personal loans, car loans, that kind of thing. That does not directly affect mortgage rates. However, it does put pressure into the mortgage-backed security market, because if the Fed has to reduce rates to continue the economy going at a certain pace and certain momentum, then it's going to exacerbate the problem we have in the stock market already, which is people looking for safe havens to put their money, which is bonds. And the bond rates have just been just clobbered. So I wanted to make sure I made it super clear to you that this is not going to impact building, and it's not going to impact the housing shortage that we have. Now, the housing shortage we have is because building is still on its way. We're expecting that to still happen in 2020 and 2021. So we're not expecting that to slow down at all. In fact, if money is made cheaper, it might mean that the builders can build quicker or build more, provided they have the labor and the access to supplies. If the money is cheaper to get, then there's a chance that they could just do more of it. What's really going to be telling in the months ahead is to see what happens here stateside for us in our local and our statewide economies as new cases come up and we have to make contingency plans in life. It's going to be interesting to see what happens specifically in the real estate market in your local town as well as ours. Right now, I don't yet see that there's going to be any slowing of what's happening, but definitely keep your eyes open for the coming weeks ahead, and just really pay attention to the ripple effect and the cascading effect that one thing can have in an overall marketplace. So if you have specific questions pertaining to your scenario or the timing of your decision to buy a house or refinance, please send us a direct message. You can leave a comment down below and let us know how we can help you out and maybe shed some light on all this scenario and what that means for you specifically. Thank you for watching Monday Mortgage Minute. We hope you stay well and you stay healthy, and we'll see you again next week.